hit on the other end, like in terms of FX and depreciation. So there are some some short environment or like cycle where you can make money if you're like in the right side in terms of currency, but you can make like very strong return like this year. Like you have like around like 18% in the local markets, and this return like half of it come from FX, the FX contribution, and so you can go from 9 to 18 or to 0 and sometimes -9. So just I think have to be very careful in this kind of market. It's a different kind of animal with very high volatility. And back in 2010, a lot of like institutional investor in Europe like bought like the past return of the asset class, which has been like pretty strong thanks to the positive FX direction in terms of EM. And then the market like the lost something like more than 30%, and a lot of institutional investors in France, at least, a lot of them, like when we went to see them, like over the last couple of years, and you say, we want to show you like an EM fixed income fund, and say, oh no, we already like tried, and we took a huge hit in that market, like 30% drawdown, something like that. So how come, like? You shouldn't lose like 30% on a fixed income product, and that's the main reason why we can have a few exposure on local rate market, but mainly we hedge the FX risk, so we play the duration call mainly. But so it's more like a FX products than fixed income products with very high volatility. So yeah, sure, if you have a strong conviction on EMFX, it's fine to do some, but just like like you have to know like the kind of volatility like you get in. Another thing we like in EM sovereign debt compared to EM corporate, like EM corporate debt market, which is in hard currency too, has been probably the fastest growing market like over the last decade, and probably that's the best performing one like over the last 3 to 4 years, and it's you can compare that to what we've seen in the high yield market, high yield corporate market, but even in euro or US dollar, like the best fixed income market over the last 3 to 4 years are mainly found like inside the high yield corporate space, like maybe like US market, euro market, or even EM market. And there's one simple reason for that. Usually, like it's quite low duration market. The corporate one, I mean, the high yield corporate market has very low duration, so they haven't been hit by the duration shock we've had like in 2022 compared to sovereign debt market. I mean, the main difference between sovereign debt in hard currency and corporate in hard currency is the duration. You have more duration risk in sovereign because usually like sovereign like are able to borrow money at longer maturities. So our market, the sovereign debt market in hard currency, has been quite hit in 2022. It has been the worst drawdown in history on our market. It hasn't been the case in corporate because of lower maturity, lower duration. So they haven't been hit by the duration risk and shock at the time. And in the meantime, since 2020, with the COVID and then the Ukraine war, there have been whatever it takes in terms of fiscal expenses all over the world, and but many countries, at least those who had like some fiscal spaces, they massively used it, and sometimes too much. And what you can see here, we had a lot of like sovereign defaults since like 2018 until 2024, and more than historically you have like one default per year in hard currency. And there's been a lot of default because many countries have been using their fiscal space, and for those who haven't been able to do so, and who or didn't have like central banks to like monetize their deficit, and so mainly the more fragile ones, those who already have had fragilities before that, some of them defaulted, like Sri Lanka, Ghana, Zambia, Ukraine, or you name it. And So you had like a lot of defaults in the sovereign space, and otherwise you have a lot of like increase in sovereign deficit, and mainly to save the economic activity. So everybody like every government like borrowed a lot of money or increased the deficit to spend money to consumer, to corporates, and to be sure there's no increase in how do you say to be sure there's no recession and no corporate default. So over the last like 5 to 7 years, there's been a massive increase in default rate in sovereign, but in the meantime, like there has been no default in the corporate space, and because no recession risk, and that's another main reason why corporate, i.e., corporate, has been one of the best performer. And we think this is over now. Like we should have like a normalization going forward. Like no, right now, like most of the sovereign, like they are like too much indebtedness, so they need to deleverage. In the meantime, like the corporate has been like quite well managed. The debt level across the world is pretty low. So on a medium-term horizon, you should see a deleverage in the sovereign part, and then another re-leverage from the corporate side. And at least, how do you say that? We should see like more like classic or typical like business cycle. The business cycle has been like over for the last 5 to 7 years, thanks to government deficit. But it's not the case anymore. So, and we started to see that this year, like when there's some like more market stress, like since Liberation Day, and we've seen like more like a spread widening on the corporate space than on the sovereign one. And because we still have like a premium, like sovereign spread are trading like higher than the corporate ones at the same level of rating, and it's a nonsense. It's a nonsense historically. Like you can see here on this table on the left-hand side, the cumulative default rate for sovereign over the last like 50 years, and the same thing as the cumulative default rate for corporate over the last 40 plus years. And you can see on a like 6-year horizon, up to 6-year horizon, the default rate on sovereign is lower than the corporate default rates. And so like corporate spread or whatever, like whatever spread should compensate for this risk, for the default risk. And historically, like this, like what you find here in green, like before this episode, like this 5 to 7 years of default. Before that, if you were doing the same like exercise, like in 2020, it was the default rates were lower, like all over the place, like on every kind of what do you say, rating bucket on any horizon. And I think this should be the case like in a few years' time. So historically, you have lower default rate, but still at the moment you still have like higher credit spread on sovereign than corporate, and I think it's a nonsense. And then there's been a lot of default, but it's different than in the corporate market. Usually, when you talk about default in corporate, it's quite a bad news because you have a very like a low recovery rate, and there's like some corporate liquidation, and then depending on the company, but usually you don't get much, like something around like 30% recovery rate. It's very different on the sovereign space because you don't liquidate a country, and most of the countries that default, they have to like manage and take into account like many of their creditors' interests, because at one point in time they're gonna have to borrow money back to international investors. That's one reason, like they take probably more into consideration like investor interest. And then you can see maybe to illustrate that, like over the last 5 to 6 years, the countries that defaulted, like you can see the return of these countries, of this debt, which after they defaulted, like just after they announced their default, and on all of them, you had like a annualized return between 15 and 25% per year. I mean, so very liquid market. It's probably more liquid. It's not the case in the corporate space. When you have a default in corporate, you don't have any liquidity. It's a very tough market. So better liquidity, even if you have like default. The main thing is just it's to how do you say, to avoid the jump to default, like just not to be involved in these countries which exhibit like strong vulnerabilities and which are at risk of jumping to default. But then once the default, you have to be able to select some of them, and then you can have like very strong return. Diversification. I don't know if you have questions. Don't hesitate to stop me. And
you are on mute. Huh? You are on mute. Federico, non ti possiamo
you're on
sentire.
mute. You're on mute. If you
Okay. Sorry. Do you hear me?
Yes, we do.
Perfect.
Okay. Sorry. On slide 12, I'm pretty good. Yeah, this one. What's the difference between blue and orange wine on the graph?
Sorry. Sorry, I didn't put the correct legend. It's a hard currency and local currency, sovereign.
Okay. Yeah.
So I think to me like the blue one is hard currency and the yellow one, orange one, is local currency. We're gonna send you the presentation, and it's gonna be like fixed, and I'm gonna put the correct like name on it, because sometimes they default in local currency but not in hard currency, and it's easier to default on local currency or whatever. So that's another reason. Usually, like default on local currency are higher, like default rates in local currency are higher than in hard currency, because it's easier for a country, like they manage it internally.
Okay.
And rating agencies are like watching and separate them, because it's two different kind of market. And so quite low correlation between euro aggregate and EM sovereign debt in hard currency, like around 50% historically, which means like if you do like a efficient frontier, and like it makes sense to have some diversification, so you increase your expected return and decrease your volatility. I'm sure you're aware of that. But then I do liquidity. You can see here it's like from straight out from Bloomberg, and you have like historically like quite high like liquidity score, like close to what you get in IG euro, and it's been like tougher in 2022 because of the what happened on the US rate market, and so there's been a decrease in duration, like product appetite. So it's kind of score like that reflects supply and demand, and when you have like less appetite for duration product, for sure you have like a decrease in this liquidity score, but still it's trying to normalize at the moment. So yeah, to sum up, like attractive risk return like profile and strong decorrelation, deep liquid market, and optimal diversification, like 70 plus countries, and opportunities across all market cycles, I said, because of a mix of IG and high yield product. And it's it's probably one of the last market when you can have some say that you can outperform I won't say like easily, but you can outperform like passive fund ETF for sure, because it's for ETF mainly for one reason, because how do you say that, like management fees for ETF are quite high in this area, like around like 40 between 40 and 50 basis points. So it's quite a lot for an ETF. It's definitely not what you have like an equity ETF, whatever. If you find some like with lower fees, I'm interested to know about them, but for sure it's not the case. And then when you have like some trouble on some issuers, like we said, the main thing is to like kind of try to avoid like the worst country, the one who's gonna jump to default, and then after that you can step in if you want, if you like the countries or the recovery story behind that. But for ETF. Like, so when something like trying to get bad for one country, you can sell it like during the months. Like if you're an ETF manager, like you don't sell the countries like getting worse, because you just have to wait for the end of the month to rebalance your fund. So just to how do you say that, to replicate the index, and usually if a country is bad, say that weight adjustment is going to be like made once a month. So for just that simple reason, usually ETF has doing quite bad on that market, and you can look at the return, like comparate returns between our fund or many funds on ETF, and even like benchmarks, and usually they do like the index minus 45 basis points per year. And then the high recovery rate you can have like on default countries with very strong return, like on a multi-year like basis. So our investment universe is mainly focused on EM sovereign hard currency. It's mainly a dollar market, like 85% of the market is denominated in US dollar. Still, you have like some issuers in euro. So around like 15% of the market. It's mainly like they are mainly located in Eastern Europe, and we can invest in them. Like sometimes we can have to do some relative value. Like at the moment we like Romania in our fund, and we like Romania in dollar, in euro, although you have like kind of a pickup in terms of spread, higher yield to maturity. And so we have like exposure on both of them. In Colombia, they issued recently in euro. They have been absent of this market for many years, and to try to diversify their borrowing away from the US dollar. So they came to the euro market this year for quite a few bonds. So we participate to one. So we have one exposure in Colombia in euro, but it's mainly we are like 90% invested in US dollar. We can do some local rate market up to 15%. We can do some corporate in dollar up to 20%. The sum of both, like local rate market and corporate, is capped at 20%. We are not structurally invested in these markets. We just want to have the ability to invest in them. Like at one point, we think it can make sense just to generate some more alpha. We think at different point of the cycle, like we should have been invested in the EM high yield corporate for sure, like in 2022, 2023. At the time, there was like some kind of recession risk, like that never happened. But so we thought it would materialize, and it didn't, and we were wrong for that. But no, we don't think it for what I said, because I think at the one point the deleveraging of the sovereign and the re-leveraging of the corporate, we think it's not the best moment to get involved in this market. So we missed the opportunity like 2 or 3 years ago. But no, we just want to stay away from high yield corporate EM. So we don't have like, we have like 1%, but it's not high yield. It's a mini short-term investment. And in local rate market, like we can invest in them, but we don't take the FX risk. As I said, we don't want the volatility of the FX. So like right now, we have 2 exposure left, one in Brazilian real and one in Mexican peso. And 2 countries where we think there's some like more, we expect more like expectation of policy rate cuts, and which are not priced in the medium to long end of the curve. So we are involved in these 2 countries for like around like 3% of the fund, and on both exposure, like we cover the FX risk. So meaning we lose a part of the carry. Like as I said, like in Brazil, we invested at one point at around like 15% in 2031 maturity. Now it's trading around like 13.1%, and so 15% carry on the bond, and the hedging cost analyzed was around like 8.5%. So when we initiate the trade, the hedge carry was like 15 minus 8.5, so 6.8, 6.5, which was higher than what you will get on the US dollar curve of the Brazil on the same maturity. So it was pretty nice trade to us. So better carry, even hedged, and then we were like anticipating like a decrease of the yield, and which happened, and we think there's still some room to go. So we mainly made some capital appreciation from the duration like exposure, but not from the FX at all. For sure, if we haven't hedged, like we would have done even a better return on that trade, but it's not the case. We don't know, because yeah, you can make like maybe like 25% instead of 15, but you can have like a 0, and we're just fine with that. So we're not supposed to be invested in this market like structurally. It's up to 15%, the sum of both of 20 if you have some corporate, 15 in local rate market, and the maximum exposure we can have on FX and EMFX is 5%. It's like kind of residual exposure, like after hedging this EMFX risk. Our process is like focus. We have like a senior advisor.
Sorry,
yes.
yeah. You also have some kind of limits in terms of concentration for single sectors or single geographical areas, for example.
No, we don't have any limit in terms of geographical, in terms of fix. We don't have much sector because we are not really invested in corporate. So, but in terms of geography or country, no, we don't have any limit. The only limit we have are the class typical like UCITS limits. You know, at least I think the French one, like you know, the 5, 10, 20, 40% ratio. Like we can be invested more than 5% in one issuer. And if we are the sum of all issuer, we invest. If we invest over like 5%, it is capped to 10%. So it's forbidden to invest more than 10% in any issuer. And the sum of all issuer, like we invested between 5 and 10%, the sum of all of them can be above 40%. So I think it's UCITS like kind of restriction, at least in the French market. It's quite stringent, but. So it's the kind of diversification rule we have to follow. But otherwise, we could be fully invested in Latin America or in Europe. We don't have any restriction here. So our investment process is like on the bottom up part, it's mainly focused about kind of quantification of expected return and the embedded risk of the fund to maximize the portfolio convexity. So like around 3 main themes like calibration, conviction, and convexity. Something new we implemented this summer with some senior advisor who joined us, someone who have a strong expertise in terms of risk management. He used to be a risk manager for a big asset management company like in France. And so he worked with us like to implement something more to quantify like a different scenario in terms of the reference rate and the credit selection. As a credit market, you know, for a country as it is in dollar, usually you have like the reference curve, which is the US dollar curve, the treasury curve, and then you have a credit spread, which is a default risk of any issuers, and we separate both of them. And you can see maybe an example here. So you can see here. So we have like on the US reference rate, we have like a central scenario where what is our scenario for the next 2 to 3 months in terms of curve and for each tenor of the curve, and then we have an adverse scenario. And it's not like a what do you say, like 99% of our like tail risk. It's more like 90% kind of tail risk in terms of our scenario. But and so we calculate like our P&L in absolute basis, but although the alpha generated against the benchmark, depending on both scenario. And then we have although like scenario, central scenario, and adverse scenario on each region and each credit rating bucket. And like for each of them, we look at like risk allocation in terms of duration, exposure, yield contribution, and then our scenario in terms of spread compression or spread widening. And then we calculate our P&L in the central scenario and then in the adverse scenario. And we do that like for all region, but also all strategy. Maybe just to show you a quick overview of the portfolio. So you have here like in US dollar, in euro, in different currency, and then we have like kind of cockpit summary. And you can see here the total contribution of the fund. So here in US dollar, because it's mainly US dollar, you can see like the duration allocation, like 5.6, but yeah, we have also 0.3 in euro. So you can see here a diversification. As I say, it's mainly in Europe. Here it's a diversification in Romania, and we have one in LATAM, which is Colombia. And then you can see so risk allocation, what happened in terms of return in both scenarios. And then we do the same in our like Mexican exposure in local rate and also Brazilian exposure in BRL. And then on both, you also have like central and adverse scenario and the PNL in absolute term and in relative term. And here you have the sum of all of our exposure. So you can see here in both scenario, we expect like some positive alpha generation in that case, and we're working to improve and have the best convexity we can have like at any time in our process. And so this is for the kind of like top-down approach and portfolio construction. And then in terms of country selection, it's mainly focused around like country selection with our internal like scoring like tool like I've made like 12 years ago. And here the idea is to have a view of like any country, like their main strengths and vulnerabilities, to look at them like how do you say, like a kind of balance sheet kind of view, and then to see how it has evolved and the trend behind that, what matters the most. So kind of yeah, what's the direction of it? Is it bad? Is it getting worse? Is it getting better? And then we kind of cross-check that with what the market think in terms of valuation, but also what the rating agencies think about that, because they mainly do the same kind of job with the same data, but then they have a qualitative assessment, and we compared their assessment to ours and then to the market expectation and valuation. And just so this index, like vulnerability index, like has been made using like taking into account like past crises and try to identify like main, you say like key indicators, like which are like gathered into like 5 main categories, which are like classical one, like you can find in terms economic situation, like GDP growth, inflation rate, GDP per capita. Then we look at public finances with indebtedness of the country, the part of the debt which is denominated in hard currency, what we call historically like the original sin. So for a country, if it borrows in external currency, usually there's a FX risk in case like there's a appreciation of the currency is in debt. He borrowed money with, and it's usually what happens when the dollar gets stronger. It's often like very bad for many like countries, and this is definitely what happened for the last like decade. And we think there's a complete reversal here, but I'm gonna talk about it a little bit further. And then we have to look at the external sector, look at current account deficit, how much like foreign exchange reserves there is in the country, their ability to cover this their external debt by current account revenue. It's a revenue from their exports. We have to look at the financial sector to kind of look at the type of crisis we've seen in Asia in 1998. We started mainly from the banking sector. So, for example, we look at credit growth, we look at bankarization of a country, and so how much of the credit growth is made by foreign banks, because It's, for example, what happened in Europe when we've had like the Euro crisis at the time. For example, Romania was Romanian activity. Romanian bank corporates were mainly funded by Western European banks, and at the time, many, like for example, the French government, when they helped and they saved like French banks, they asked them to repatriate the fund and to finance only the French economy. And many like countries did the same thing. So there's been a massive vacuum in Romania, and overnight, like there's been like no financing anymore, like for many corporates. So there's been massive like economic and financial hit at the time here. So the kind of vulnerability we look at, and then we have like governance indicators. One which are like quite famous now from the World Bank, which are very like meaningful in the EM space, mainly the most fragile or distressed countries. So we look at the rule of law and political stability, how do you say, regulation, quality of the regulation, and level of corruption, stuff like that. So kind of like qualitative indicators. It's something which is like mainly like quantitative, and then we do some Z-score. Do you say treatment, and to add all these indicators and to have a final like a magic number, I will say, and just so we can rank like all of our country in our investment universe. You can see here on the left hand side, like from the best to the worst, and so it's as it is a Z-score. It's like kind of a relative indicator. So it doesn't tell you if it's the whole universe is getting worse or better, but it can tell you if one country is better than the average of the investment universe. So it helps us like to identify how to how do you say, like to look at the country, like entire universe, and then you can split between different like groups. And for all of the country, like you have this kind of spider web, and you can see like quite quickly where the strengths and weaknesses of a country are. Like here, for example, it's Ivory Coast, and you can see it's like total like appreciation. It's quite fine. It's close to the average of the investment universe, and the strengths of the country are mainly like the economic situation with very strong growth, like quite low inflation, and public finances are okay, quite low indebtedness, not much like debt in hard currency. External situation is pretty fine, pretty high, like current account surplus. No vulnerability in the financial sectors. You don't have like much credit growth. So bancarization is very low there, and you have no financing from like foreign banks. But the main weakness is on the governance side. In governance, it's mainly on the political stability and violence historically, because there's been like a lot of like riots like 20 years ago, but there's been some quite big improvement on that front, and almost like all governance indicators have been improving like for the last decades, and we've had like election recently, and they went like pretty like quite straightforward. So it's a country we like, and when you look at the trend, it's still pretty good and above the average here, and you can compare them with all different kind of sub-Saharan of Africa country, like for example, and then we look cross-check this view with rating agencies to see how they rate the country, and to see there's like some room of some space. Is there like quite well? Like, is they fit well with their rating from Moody's or S&P or Fitch? We look at all of them, and you can see they could be upgraded or even downgraded, but look quite fine in terms of rating, like on this appreciate assessment. And then we look at the valuation, and we compare with other countries. And what's interesting here is what the market thing, and sometimes there's some like divergence between market valuation and our own appreciation, and then we try to find where. So there's a big like kind of qualitative work after that. So it just how do you say, like the backbone of the investment process in terms of country selection. Like you start with that. We just want to know. It's like low. How do you say? Some it's really fundamental, like assessment of the country. Like we just have a strong view, like strong fundamental view of on any country. Like we really want to see and to know the strength of weaknesses of any country. But then you have to follow like cyclical data and any like development on a daily basis. So and we just want to have the big picture. It's kind of what helps us like to have a strong view on any country and to see if we want to get involved or not in the country. I don't know if you have any question on this part of the process. Otherwise, I would jump like quite quickly on the macroeconomic environment.
Yeah, the process was clear. Thank you.
Okay, thanks. So yeah, on the investment case, we think it's we very positive and fundamentally in the asset class still for many reasons. Like first, we think the countries have been doing some like incredible job in terms of like institutional improvement. Like as I said, there has been a lot of default. Like for the last 5 to 7 years, it's been very tough for many countries. They have been they've had like very adverse environment. Like one of them, was the strength of the US dollar. There's a strong correlation between emerging markets and US dollar, but as I said, I was talking about the original sin, and for many like developing market, which are like middle income kind of countries, like most of them, they don't have like the ability to borrow in their own currency. So when they need like international savings, usually they borrow in US dollar because investors are more like secure to lend them in that money for the reason I said, like no legal risk, no jurisdiction risk, whatever. But still, their indebtedness is in dollars. So when there is dollar appreciation against their currency, their level of debt increase only with the FX, with the FX appreciation, without doing anything. And this dollar appreciation, although like increase import prices, so it increased like domestic inflation. In the meantime, like the central bank has to hike its policy rates, so it cuts like economic activity, like so it decreased like growth, so it increased indebtedness. So you see the typical like vicious cycle you see when you have like a strong dollar appreciation, and you can see here like in terms of dollar in the real effective exchange rate, you had like a decade of appreciation. Usually you have like very like long cycle, and we think so it peaked like at the end of last year, and we think we start like a downward trend and the dollar, and it's been like quite flat like since this summer, but we think it's going to resume its downward trend like next year, and it's going to last a few years, and that's what the US administration is looking. They're trying to fix their current account deficit, and for that they want a lower dollar. So and they're doing anything so to lower it, I would say. So I think it's a like strong push like in favor of emerging markets. And in the meantime, as I said, like as they've been like facing this quite tough environment with the COVID and then the Ukraine war with a huge increase in the food prices or energy prices or whatever. So there's been it's been quite difficult for many countries which have been under like IMF program with a lot of like strong measures and hard and tough measures, political decision taken, like the kind of decision we're not able to make anymore in France, for example. Yeah. So many countries they've had like to hike their policy rates and to reduce their energy subsidies, and so very like unpopular decision, and with sometimes like kind of social unrest. So a lot of political courage, and I think it's delivered on that, and you can see here when you look at like key economic figure, like at the moment, and you have like still very, very strong growth there, like 2.5 points higher than in developed markets, almost the same level of inflation globally on average, current account surplus in many countries, budget deficit, which is quite the same, but still in the meantime, they have like a primary surplus and on average, and the policy rates are way higher, like around like 200 basis points. So they still have like pretty high real rates, and there's still room for them to cut their policy rates and to kind of help and stimulate their economic activity. So when you look like basic fundamentals on many emerging markets, they are very stronger like metric than many developed markets, and they have been very like kind of doing their homework, and they deserve credit for that. And it's you say like many developing markets and economies, they try to improve their institutional framework and their governance and abilities, and yeah, trying to how do you say that, to improve their institutional credibility, and for sure, and for investors. And in the meantime, you see there's some we're talking about like central bank independence in many developed markets, which are on the table in the US, for example, but not only. And in many of these countries, like they've been implementing like inflation targeting and central bank independence, fiscal rules, and many things like kind of delivered and are still delivering. So I think there's like market taking stock in a way of this improvement, and for investor looking to diversify away for US or even to diversify their risk, and that just don't want to be exposed anymore only to the European market or developed markets. I think there's a lot of good opportunities inside the emerging markets fixed income space. US dollar, we still expect some lower rates. We don't know it's going to be like 50, 75, 100 basis points like next year, but whatever, like what matters is more the trend. And anyway, the real rates there is still pretty high, and we still expect like growth to be, we don't expect recession there, but there's for sure like some kind of risk. It's quite tough job for the Fed at the moment, and hopefully the shutdown is now over, at least until the end of January. So gonna be able to have like more data, and they're gonna be less in a fog. But yeah, there's still room for them to cut and to have more like a more neutral rate. And in the meantime, like you don't have like an inflation like sign at the moment, and the IE like kind of revolution we see right now are more like has more like a disinflationary effect like at the moment, like when you look at the wages. And so we think definitely room for more cut. And in the meantime, you're gonna have the midterms next year in the US, and so the Republicans are not really in a good like trend at the moment. So probably like the Trump administration probably is gonna turn up more pro growth next year. So probably more fiscal use. In the meantime, like less like lower real rates there. So meaning more cuts. So trend which are like which would translate into a lower US dollar, which I think is good like for emerging markets globally. In terms of valuation, we still like the asset class for sure. We've had like a strong rally like over the year, but still like on an historical basis, you can see here like yield to maturity is still pretty high, like a little bit less than 7% in US dollar, which is probably one of the highest you could have like for the last like 20 years, and way better than when you can get in the euro market for sure. The market is half investment grade and half high yield. And if you look at the high yield market, there's still room for spread compression, like here on the right hand side. So we've had like already some quite high like compression, but still we are on like 460 basis points, and in a very like rich credit environment at the moment. Like all the credit markets are their all-time ever. And if you look at the high yield, like corporate in euro, in dollar, and the IG the same. Like you have to go back to 2004, 2007, like to have this level of spread, and it's not the case in the sovereign space. You still have a lot of room for compression compared to other markets. So even if there's a widening at one point of some market stress, there's more like ability to there's more buffer because higher carry in face of any kind of widening, and then less probably like widening the other market because there's not the kind of excess in terms of valuation you can see in many like high yield. There's another reason like around like the normalization between high yield spread, as I said, between like default, corporate default, and sovereign default. So yeah, there have been like no corporate default for sure, but it's clearly like priced in the market at the moment, and it's not the case in the sovereign. The sovereign defaults are past, are behind us, and so there should be this like normalization, like both spreads should cross, and historically like sovereign spread used to be like tighter than corporate spread. So I think that's what we should see like for the last the next like cycle going forward. And we started like because of this like better fundamentals and quite like nice valuation, attractive valuation, we started to see some inflows back to the asset class. So we've had like 150 billion outflows over the last 2 years. 2022 was the worst year ever, like 90 billion outflows, and still 31 in 2023, almost 30 last year, and this year we started to see inflow back since the summer, and this definitely like push like spread tighter for sure. But it's I think it's a good thing, and we can it can help and give some more boost for 2026 return. Expected return is going to be tough like to have the same kind of return we had this year, like almost 14% in US dollar and 12% in euro hedged. But we expect more like a return around the carry, like around like 6.5 in US dollar and around 4.5 to 5% in euro hedge, but with more inflows. Like you can have like tighter spreads, and if you get like you go back to the same kind of flow or historical level you had on any other like credit market, we can more have like kind of double-digit kind of return for 2026. But our central or base case is more something around the carry. I don't know if you have any question. Yeah.
No, I don't have much time. Are we close to the conclusion?
Yeah, sure. Well, I think we're done now. Then have a different kind of like investment theme we have in the fund, and we can just a few like the return, historical return. You can see here. So the ability, as I say, like we like to have more like a convexity approach and to limit the drawdown in terms of like negative markets, and still to participate in much of the positive return, which has been the case historically. I don't know if like ESG is something that matters to you, like if you are sustainability investment, something you're looking at or not at all. Does ESG like matters for you?
Yeah. I monitor almost weekly the performance of your funds. It's one of my tasks, so I know very well the performance. I was curious about the investment process and the way you look at how to compose the portfolio. That was really interesting.
Okay, are you looking at sustainable funds or not at all?
Sorry?
Sustainable funds? Is it something important for you?
That was very
Sustainability investment.
No. Right now we're not looking at a sustainability measure because clients stop thinking about this. They're more focused on performance right now.
Sure. Okay. Okay, great. So here you have like a quick snapshot of the fund, and you can see yield to maturity in US dollar. It's a bit higher than the market, around like 7% at the moment, like with 6.2 interest rate duration. average rating is between BB plus and BBB minus. Like at the end of the month, it was more like BB plus, and the volatility is getting lower. Like we went at the highest point in time.
Sorry, what's the average turnover? I mean, you also have some kind of trading approach. I mean, or you tend to keep the bonds until maturity?
No, not at all. We are not like a fixed maturity kind of fund. So no, we have like a kind of trading approach which is linked to our scenario. Like as I said, like our bucket scenario, you can see. Let me show you here. So, for example, we have target like in if you look at the triple B plus in LATAM, for example, it's mainly like Uruguay and Codelco, the Chilean company, like for 70% of the risk allocation, 30% for the bench. I mean, and so for in our scenario, like we have like a scenario for all different like issuer of the rating spectrum. For them, like we have like target in terms of spread, like in terms of compression or widening, and when we are our target are hit, like we move looking at the reason behind that, but we can move the our exposure there, and the turnover is around like between 40 and 50%.
Yeah, 15%. Okay. And it depends only on macro environment, or you have like a target price, and if liquidity is there, you sell when you reach your target.
No, here it is definitely like target price. It's in terms of spread, so it is target price. But after it's depending on the market environment for sure. So we have like a it's what do you say? Like you cross-check the macro view. So you look at the inflows from the asset class, risk sentiment, and market appetite for the emerging like risk. But you look at it also like country by country. So there's like many how do you say? Not studies, but we participate to some question from brokers. The main one is JP Morgan. Like each month they do like a sentiment request to investors on each country, so you can kind of have a view of market positioning on each country and market sentiment. So the kind of technical view on the market. So there's also like a cross check between fundamentals and technical and valuations, and this on a country basis, but also on the asset class in the meantime. So it's a cross check of both of them, and then so we have like target in terms of spread on each country, although in terms of curve, US curve, reference curve, and depending on our scenario, and then when our target are hit, so we do like a refresh. So we have a meeting like once a week, and we can adjust our targets on the central scenario, but also on the adverse one.
Okay, again.
Do you have any more question, or is finished for you, Federico?
No, all the presentation was very clear. I guess this is private material. I cannot get this presentation, but I found very useful the data I saw there.
Okay.
So okay. So
Stefano gonna send it to you.
If possible, it would be appreciated. Then okay, I think I have a clear overview of how your reasoning works regarding the selection. And now I think we are approaching a new phase after the change in the Fed seat. So we will see